The price to book value multiple, again, as we all know, the price to book value multiple can simply be used for those companies having the book value of the assets, asset intensive companies, and most importantly for banks, the private sector banks, the public sector banks, NBFCs, insurance companies per se. But here we need to understand is that we can derive the intrinsic price to book value multiple, right? So as I've said already, right, that these multiples of relative valuation, these are pricing multiples and not valuing multiples. Because we're just trying to price your company based upon some other companies' price in the market, right? But we can find something as an intrinsic price to book value multiple via the company's ROEs, the cost of capital, the growth rate, right? So basically the price to book value multiple, it simply becomes the ROE minus the growth rate divided by the spread of the cost of capital minus the growth rate. It's an ROE driven price to book value multiple, or an ROE driven intrinsic price to book value multiple. So if we have those numbers, we can simply ascertain the company's intrinsic price to book value multiple and not just a relative pricing book value multiple. Now we can compare this multiple with the price to book value multiple the company is trading in the market. If the company is trading at a higher price to book value multiple, we can assume the company is overvalued. But if the company is trading below this ROE driven price to book value multiple, the company might be undervalued. So the price to book value multiple is not easy as it seems. It's always a combination or a factor of the ROEs, the cost of capital, and the growth rate.